Now I'm going to show you the financial checklist spreadsheet that I'll be sending you. Now, on the tab instructions, it shows you everything that you're going to need to do. So you'll be creating your balance sheet. You'll be looking at various option examples. Then you'll be populating your contributions and future needs. Once you've completed all that, you'll be able to take the balance sheet and the contributions for your legal advice session. This enables the lawyer to be able to have a real picture of what your financial situation is for your family, so that you can each take that information to each of your independent legal advice sessions, so that you're able to both get a similar feedback on what the outcome should be. Today, I think most people rush out to their lawyers, give half the story. They may forget to say, oh, you know, my ex had an inheritance, or they might forget to miss out pertinent information about the ex's contributions, or their future needs. And therefore, you can be given an assessment of what you could achieve, which may not have the full picture. So from the start of the instructions, you're going to be creating your balance sheet. So first of all, go to the tab to have a look at a balance sheet example. So you can see here, there's an example where there's been the population of the different values for each of the items that you might have. So you might have a home that you think's worth $1 million. Your ex might think it's worth 1.2. But once you have your paid valuation or your market appraisals, you might come to an agreement. Oh yeah, we're going to say it's worth 1.1. You've got to put in who is the owner. So the owner is based on who is on the title. That could be on you could look up your council rates, and that'll generally tell you what names those are in. So that will give you an indication who is on the title. Then you've got cars. You can put in your cars. Both of you might have different values that you're thinking that each car's worth. And once again, you go onto carsales.com, get a screenshot, and be able to then come to an agreed value. So you're always putting the agreed value in column D. You're putting the owner in column E, who those assets belong to. And to start off, you're putting in columns B and C, what values you each think each thing is worth. So you're going to populate all that, going down through all of the different things. You'll have different bank accounts, and it's key to be able to sort of type in what the account number is on each one, so you have an identifier. During the financial disclosure, you'll have your supporting documentation. You'll be able to show each other to be able to confirm what that agreed value is going to be. So then it will list down the bottom what your agreed value of your assets are. So this is in column D, so all the agreed values. So you're saying, yep, that's what our property pool is worth. And then you're coming down here to liabilities, and this is where you put in your loan for your house. There might be a car loan, there might be investment properties, shares, you might have a loan for your shares, credit cards, things like that. There might be tax debts, capital gains if you've got an investment property that you're selling or have sold in the past. And then you go down to super. So superannuation, this is outlining what each person's super is, what the agreed value is based on the statements. And then obviously you've got the totals at the bottom of each of those sections. And then you might want to have a look at saying, just trialing, okay, well, what do we think the split might look like? So you can do this individually, you can do it just yourself, or you can even leave it blank and then wait for your legal consult to be able to talk to you about what that might look like. So you might say, oh, it's going to be a 45-55 split of the house, and this is what it'll equate to. That will automatically calculate. So you just put in the percentages. So here, John's keeping his own car, 100%, and Jane's keeping her car. So you put 100% there, and it'll automatically put the figures in. That's John's shares. So John's thinking of keeping his shares and his boat. So you can see how it all goes through. When it's general household contents, just be sure that you're putting in what you would think the household contents, the furniture, would be if you were just to sell everything on Facebook Marketplace or in a garage sale. So it's not your resale, it's not your insurance value, it's what your resale value is if you were to go out and sell it today. So you just populate that and just make sure that, it all adds up to 100%. So you can't put like 100% there and 100% there or 100 there and 55 there. Just make sure that the columns together equate to 100%. And then it will show you what the total for party A is for this example and what party B's is. And it will calculate what the percentages are for the assets. Then you've got the same for liabilities, the debts. Always ensure that your mortgage is at the same percentage as what you have in the overall split up here. So just make sure that that's the case, because the mortgage gets paid before you split the equity anyway. So you just want to make sure it just replicates exactly the same percentage as above. And then just outlining who's getting what. And in your debts, who's going to continue to carry those debts going forward. And then your superannuation, just working out what are you going to do there. So in this example, for John's super of 124,500, he's going to keep 70% for himself and do a super split to give Jane 30%. So that's what equates to those totals. And Jane will keep her super 100%. So that's where those percentages pop out there. So then you come down here and the total net assets, excluding the super, is the assets minus the liabilities. With the percentage split, this is how much is split that each party will get and what each party's percentage will be. Now, including super, so if you're going to have the super included, which most people do, then you've got the total here, what each party is going to receive and what the percentage is. So that's the example. So then you'd go back to the balance sheet and you'd start populating for yourself. So you might say, once again, your house is worth 800,000, but your partner or your ex-partner might say, oh, it's only worth 750. So when you see that each of these areas are different, you need to get to an agreed value. So that's where you go and get your market appraisals or your paid valuation. With a property that's hoping to be retained by one person, it's always highly recommended to get a paid valuation, because then that is going to be the exact figure that the property is valued at. They'll give you one figure. Whereas if you went to a real estate agent, they'll give you a range, and they'll also be trying to let you know that you'll be able to get more because they're trying to vie for your business. So it's really important just to be mindful of that. But you guys might choose to go and get market appraisals, a couple each, and then just sort of go down the middle of the road of what the value might be. Or if you're selling the property, you might think, oh, well, we just get a gut feel of what it's worth, put that in, but we know that how we're going to split it once it's sold. So it doesn't really matter if we don't get a paid valuation, because we're going to sell it anyway. So then you might say, yep, they've come back saying it is actually worth 800,000 and it's owned by both of you. And then you might be saying how much it's going to be split. So you might say, it might be 50-50, but it might be 45-55, whatever that split might be. Or, as I said before, you might not want to go down that track yet until you've had your legal advice. So you can leave it blank until you come back after that. And then obviously you've got a car each. So one might be 2,000 and the other car might be 5,000. And you might disagree with that. The other party might say, oh, your car's worth more than 2,000. I think it's worth 3,000. And then you've got to then go to carsales.com, get a screenshot and find what other cars that are similar with the make, model, year, and kilometers and condition to put in there what you think it might be worth, what other cars you see are worth. And it might come back that you both agree, oh, around 2,500. And you might both agree, yeah, Jane's car's worth $5,000, so we'll agree on that. So you're going to say that's Jane's, that's John's. Now make sure that whoever you're putting here as the owner is not the person that's going to end up with the property or the car or the shares. It's the actual owner on paper. You might say, oh yeah, the house is both of ours, but it might be in one name. Now it doesn't mean that that person gets that whole property because it's in their name. It's part of the marital property pool. So you put in the owner who is on the deed or the council rates. And then you just fill out whatever you have. Then you've got bank accounts. So John might have a bank account with $1,000 in it. Jane might have one that's got 1,000 in it as well. You both might see the statement and say, yep, that's all correct. You just go through all of the assets and it'll just tally them all up at the bottom. And at this point, if you're wanting to continue to go down, you might say, yep, John's keeping his own car 100% and Jane's keeping her car, and it'll populate over there. Same with the bank accounts. You might both decide to keep your own bank accounts. There might be a joint bank account that's got, I don't know, $10,000 in it. And you might say, yeah, we're just going to split that 50-50. Or you might say, oh yeah, you can have it because I'm going to keep, John might have a boat that's a similar amount. And he might be keeping the boat. Oops, I put it in here. Oops. Okay, so you might say, that Jane might get all of the joint account because John's going to keep the boat. So you might do it that way. And then when you get down to super, oh no, these are the the liabilities. So the mortgage, you might have a $300,000 mortgage. Say that you both agree on that. And there's no car loans. There might be a credit card though. John might have a credit card with 2,000. Jane might have 3,000. And you might say that you're going to keep your own credit cards. And you just go through, there might be a shares loan, a business loan, tax that each of you might have your tax that you need to pay the ATO. And then super. So with those different kinds of super, you might have a cumulative benefit, defined benefit. You might have a self-managed super fund or a retirement trust. Most people have a cumulative interest fund. So say John has 100,000, you both agree on that, and Jane might have 30,000. Oops. 30. So you might say, okay, well, Jane will keep her 100,000, but we want to split it so that we both have exactly the same in the end. So you might say 50-50, but you might say, well, we want to make sure that we both end up with half and half. So you might say 30 and 20. Or you might say, so overall we've got 130. So you want to be able to say that I might get that much. So you're just going to work out how much you're going to end up getting. So John might get 60, you might get 40 on the other side, so you can see 60 and 70 there, or you might get 65, 35, and it changes down here, so you're both ending up with exactly the same amount overall. So it all depends on what you both agree, of course. And then you come down and you can see the percentages, how it's all split up. So including super, it's come out at 50-50. Okay, so that's the balance sheet. So you might then, because that's showing you how much overall that you've come out with. Now, just to make sure that it's getting the right decimal points. So this is virtually 50-50. It's just slightly out, as you can see with the totals. But you can see where that's going. So that's what you've calculated for an option for yourselves. But if you want to look at other option examples, so it's pulled in what your amounts are from your balance sheet. So you could be looking at all these different options that have auto-created. So it could be option one, you're doing 50-50, but you're keeping your own supers. So overall, this is the amount of money John gets. This is the amount of money that Jane gets. This is the overall percentage that you each get. Or you might decide you're going to split 50-50 and include the super. So you're going to do 50-50 of the assets and liabilities plus the super. So then you're overall 50-50. So it goes further down where you might be doing 50-50 of the assets and liabilities, and then 45-55 super split, which gives you that 49-51%. There's different options all the way through. You might do a split 40-60 of all the assets and liabilities, but keep your own super, or include the super, or split out the super at a different ratio, and vice versa. There could be other options down here, split 30-70. So it just goes through and shows you all different combinations. But if you go back to your balance sheet, this is where you've got your totals here, and you put in your own percentages of what you're hoping to achieve. But you can go through and you can modify these, but just make sure that each column equals 100%. So you've looked at the options. Now what you're needing to do is do your contributions and future needs. So let's look at the examples. So the example here for John Doe and Jane Doe is at the start of the relationship when you moved in together. So with savings, how much savings roughly did you each have? So John had 50,000, Jane had 5,000. Now, if you can provide some old statements that you can share with each other to confirm that, if you don't agree with each other, because you really need to be able to show that you did have that. Then John might have had a property. So when you both moved in, then the value of the property minus the loan. So the equity might have been 300,000. So John bought his home in 2003 for 349 before Jane moved in July 2008. And after the sale of John's house in 2015, the equity was used to purchase our family home. So it's commentary like that you need to put in for the lawyers. Then the car. So John had a car of 50,000 and Jane had a car of 5,000. Jane had some shares at 10,000. Superannuation, John had 30,000, Jane 3. An investment property that John had, and he still owns it. So John still has his investment property, which he purchased prior to the relationship in 2007 for 299. So at the time of cohabitation, there was equity of 250. So that would be the value minus the loan. So if he had a loan that was, 600,000, but he bought it for 850. So then the value of what it's worth when they first moved in together minus what outstanding loan there is. So any other things like a business, a boat, or other items you can add in there. And it just gives the lawyers an opportunity to see what each party brought into the relationship. Then during the relationship, you want to be able to say, okay, what was the average salary throughout the relationship? You know, was John on a higher salary or Jane on a higher salary? So the average, so John was averaging 180,000, Jane was 45,000. Was there any inheritance received? Well, John received an inheritance of 100,000 from his dad in 2012, and that was used as joint funds to pay onto the joint mortgage. Now, it's really important to say what these lump sum payments were used for. Now, it could have been that John received an inheritance of 100,000, but he used it to buy a brand new car for himself. So it's really important to say, was it used for sole purposes or for joint purposes, like putting onto the mortgage? Then shares, listing out what shares that they might have had, any redundancy payout. So Jane got a redundancy payout of 50,000, and that was in 2002. And the funds were used by Jane personally to purchase a car. Then John had an injury payout. So we got a lump sum of 50,000 in 2005, and that was used as joint funds for renovations on the family home. And then Jane received a large monetary gift from family. So Jane's dad gifted for a holiday 30,000 to Jane. Now that could have been a family holiday or a holiday just for Jane. So you need to stipulate what that was used for. And then post-separation. So you have here, how was the mortgage being paid? So John was paying the mortgage solely. If both were contributing, you'd put in the dollar value per month of who's paying what. Anyone paying child support? So John's paying 1,000 a month. And living expenses. So John's paying 1,000, Jane 1,200. Investment loans, that's what John's paying, 5,000. Car loans, 1,500. Paying private school fees, daycare fees, paying rent. So you list it all out there so the lawyers can see what your post-separation contributions are. And then we look at non-financial contributions. So throughout the relationship, what was the percentage of the care of the children? So in this circumstance, it was 20% for John and 80% for Jane. And on the weekends, it was shared parenting. For domestic chores, we've got here that it was 50-50. Renovations, there were no renovations. Repairs, John did 75% of the repairs. And gardening, Jane did most of the gardening, 80%, and John did 20%. Future needs. So this is where future needs impact earning potential. So has anyone got any diagnosed health issues? So John's got depression, so that impacts his work. So the lawyer will be able to tease out more on, how does that impact? Does it mean taking time off? Does it mean not being able to get a promotion? Because, can't take on extra duties. Now, work stability, that's really important. So John's got a permanent job, so it's more stable, whereas Jane is working casual. Then income impacted by caring for children. So Jane's only part-time, so she's not able to work more than 3 days a week because she cares for young kids aged 5 and 3. Also, if there's someone caring for children with special needs, that might be impacting their earning capacity, or whether they're looking after elderly parents. There might be imminent lump sum payments coming. Now, that could be an injury payout. It could be a redundancy coming up very shortly. It could be an inheritance that's already happening, that's, with the lawyers and working through that. It doesn't mean an inheritance, her mum and dad's loaded. When they die, she's going to get millions. You can't put in that an inheritance that's going to be years to come. You can't put that in here because you don't know whether those elderly people are going to have to use all of their money for 24/7 nursing care. So you can't put that in at this point. It needs to be something that's imminent, that's in train and starting to happen. Qualifications. So we just need to know what are the qualifications of each person, because that impacts how they're going to be able to secure work into the future and what type of work. Years out of the workforce. So has a party, not had time in the workforce that's impacted them getting super. So Jane was off work for three years on mat leave, and then returned to work 3 days a week. Then the current income annual salary, John's on 80,000 and Jane's on 40. Other income, John gets monthly rental of 2,000 per month. So that's where the lawyers will have a look at your whole situation, your contributions, and your future needs to see what assessments and adjustments would be made on your possible outcome that you could achieve. So you want to be able to go in and put in your contributions for your particular family. So first of all, you'll be having your date of cohabitation, date of marriage, date of separation, and your addresses, and then listing your children, their date of birth, age, and any health conditions to consider. So as with the example that I showed you, you would be going in here and putting in, oh yeah, John had 5,000. Jane didn't have very much. She had $200 in the bank. And you just keep going through, just putting in, John had a car at the beginning of the relationship worth 10. Jane didn't have a car. So you just keep going through and saying, super, all those years ago, John had about 20,000, and Jane may have had 2,000. So you're just going through and you're painting a picture of what you had at the beginning of your relationship. And that's when you started to cohabitate. And the same with during the relationship, as we went through in the example, just putting in there exactly what has happened financially throughout your relationship, and then what's happened post separation. How much is each paying for the mortgage, any child support, and so forth. Once again, your non-financial contributions. So what's throughout the relationship, what has been the hands-on care percentage for each parent, domestic chores, renovations, repairs, gardening, or anything other that you can think of that you feel needs to be noted for the lawyers. And then you just put in there in regards to your future needs. So you just add in there for both parties so they get that full picture. So always keep coming back to, having a look at what your balance sheet is, come back to the instructions on the instructions tab. So come back to the instructions and just make sure you go through and just step by step have an understanding of what you're needing to do. And if you need any assistance to help populate the template, you can always book a session with me if you feel it's too much, that you need some help.